All right, guys. So welcome to another session of this training. Today, we're going to continue from where we stopped last time. We have been on a 30 days YouTube mentorship, and today happens to be, I think, the 20th day. Yeah, the 20th day. And I feel that today we might be having two sessions because we have to meet up with time, right? So we might be having two sessions today, one in the morning, one in the evening, right? So let's just see how we can cover up and meet up on the last day, which is 31st. All right, so today we're going to be specifically talking about CFD indices. Right, CFD indices. Right, this is one of the markets I trade. Right, is very similar to futures. Right, it's very similar to futures. If you trade futures, then you would understand CFD indices. Right, Nasdaq futures, US mini, all those stuff. So I trade futures. I don't really trade indices. I go with futures because I trade seven indices because futures are not available on all brokers, right? A lot of brokers do not have futures. So, and yeah, even prop firms too. Some of them, most of them don't have um, um, futures. So if you want to have the futures experience, trade with futures, while still you know so why still being limited, right? Because most brokers don't have futures, right? So if you want to trade what looks like this futures market, right, then the saving indices should be trading because in saving indices we have Nasdaq and we have US 30, we have um um what do you call it? We have S&P 500, we have a lot of them, G30. So the CFD indices mimic um the futures, right? It just mimic the futures. They're both derivatives. So the CFD indices mimic the future. They look like futures markets, right? They are similar, right? They're similar to the CFD indices, to the futures, but CFD indices is very low budget. That means you can trade CFD indices with very little capital, right? So futures have minimum requirement to open a contract, all those things, and the terms are different. Contract size, open one contract, this and that. But when it comes to CFD indices, you can use normal lot sizes on your MT5, right? So CFD indices just mimic futures, but they are not futures, right? They're not really futures, but they just mimic the price action of futures, right? So that is basically what it is. So I want you guys to just have back of your mind. So if you want to trade futures, not e-mini, all those stuffs, right? Then you have to do it via the CFD indices market, right? So you can see at my record. So let me just click here. So you can see them here. Just come to indices and you'll see them here. So these are affiliates. You CFD, you can see that SP500. You can see this. You can see US 100. You can see Dow Jones. These are the futures you can trade. Right, you guys. I think you should see DGI is something as is the same thing as US 30, right? So most brokers give a different name. Some people call it DST. Look at German 30. Some people call it DAX index. German 40. We have German 30. We have German 40. We have DAX index. All these things are the same, right? So for S&P is one. It's a different pair. We have G30. We have G40, which are similar in price action. We have US 30, which is the same with DGI. So DGI and US 30 are the same, right? So we have Nasdaq. We have some people call it Nas 100. Some people call it Nasdaq. Some people call it US 100. Some people call it US Tech. So it depends on the broker you're using. So that is just basically what it is. So we have Hong Kong 50. And that's also a very good one too. You can also trade it if you wish. And it's also a very good for future pair. In this pair. So then look at futures here. So as you have futures here, and then we have indices at the other corner. So futures and indices look very much alike, right? In price action, right? look very much alike in price action. So let us just do a very quick comparison. All right, so this is a 15-minute chart. Let us compare it with CFD indices. All right, so let's compare it with Nasdaq as US 100. All right, let us just do a quick comparison just to be sure that we're on the right page. Just compare that chart so you can see what I'm talking about. I think I should just click here. Right. So I want to make it candles so you can understand its candles. All right. So this is it. So you can see how similar the candles look. The one up is the future. The one down is the Nasdaq CFD indices. So you can see how they look very similar, right? So if you want to trade the CFD market, doesn't matter you're trading. If you want to trade this, doesn't matter you're trading something very similar to the futures. The only thing is the price. I think this one's at 2366. While I think this broker is off. Since this broker is off. I'm not seeing price moving, but maybe. So you can see that this is the high is at the high is at let me look at the low is at 2362, while the low is at 2201. So I think the little difference is the price. And then we are taking trades on this particular one above. You're using contract. Why? If you're taking a trade on the CFD indices, you're using lot size or your MT5 or whatever platform you use. So you can say they're similar, right? So now, one thing I like about this market is that the market is very, very volatile, right? They're very, very volatile markets, right? They move very quickly. That means if you want a trade where, sometimes I'm seeing my take profit hit within 5 minutes, right? So that's the kind of market I like sometimes. The market is very, very explosive, right? Say indices, you can see yesterday's price action, you can see a market, drop, you can see this BB candle. So the market moves very quickly, right? Moves very quickly. You can see one, two. So if you bought down here, this one candle are taking you to your take profit, and then it's second, this 15 minutes. Within 45 minutes, the market has moved from 204 up to 353. He moved 153 points, right? Just in 45 minutes. So the market tends to move very quickly. That's why most people trade this particular pair, right? That's why many people trade it because of the quick movement that it affords them, right? So that is basically it. So now, what is the time to trade CFD indices? The best time to trade CFD indices is between, it has two sessions, right? So I have the morning session, which is between what? So this is the best time to trade it because so we have between 9:30 a.m. So 9:30 a.m. I think this is the morning session to 11. So this is the morning session, right? So when I'm referring to time, I'm referring to New York time, right? So use the New York time, right? New York time, which is what the same time as GMT -4 for now, right? So New York time, that's the time I use in New York time, right? US New York. So that is the time we're using. And now you can see it. Oh yeah. So if you come to the New York Stock Exchange, well, you can see this is New York Stock Exchange market, right? So this is the New York Stock Exchange, and then you can see the open time. The open time is right here. So you can see that this area here. So by 9:30, that is when their markets sits. They open from 9:30 to 4 p.m. So that is when the market kicks off. So the market, you want to be trading saving this is when the market is open, not before it is open, because most time in the early hours of London session, the US stock exchange is not open, and the New York Stock Exchange carries most of the liquidity when it comes to the CFD indices. So you must always be mindful of that you should trade the CFD indices when the market is open. Right, that's for the morning session. Right, this is the best time to get most of the volatility between 9 to 11 a.m. Right, so that's the best time to get the volatility. That's early morning, that early volatility. So let us quickly look at that. So you can see that at this point here, it's 9:30. You can see 9:30 candle here, right? This is 9:30 candle. So can you see how? Let's just go to 5 minutes time frame or 3 minutes time. So you can see it clearly. Right, where is the 9:30 candle here? This one. Right, so this is 9:30 candle here. This particular red candle here. So you can see immediately the 9:30 opened. Can you see how quickly the price moved? You can see this quick, sudden, big movement, right? You will see it very clearly on the 1 minute. Now you will see it very clearly. You see how that market move very nice in the 1 minute. I'm also going to get the exact candle that's packed in 9:30. So 9:30 usually sees volatility, a lot of volatility, right? You can see that this 9:30 candle here, this one here. I said this candle open. Let's also zoom it more. So the red candle is the 9:30 candle. This red one here. Can you see how the market opened? You can see these big movements, and then you can see how the markets are moving impulsively, right? So that's how this market books. So you usually see volatility by 9:30 to 9:30 to um 9:30 to 11 a.m. That is most times you see volatility in the market. But doesn't mean you can't trade after 11 a.m. New York time, right? But the time you see that volatility, you want those quick trades. So you want to enter when the market is volatile. That is between 9:30 to 11 a.m. US time. Now, like I said, the pairs that are under the CFD indices are the pairs, we have NAS 100, which is also called NASDAQ, right? Which is also called NASDAQ or US Tech. Right, so anytime you see any of these US Tech or US 100, right, this is all NASDAQ, right? It depends on the broker you're using. Then we have US 30, which is also called, some brokers call it DGI, some brokers call it Dow Jones, so still the same thing. Just like we have fiber and cable, we have currency pairs called fiber and cable. So, the one that is called fiber, the one that is called cable. So, the one that is called, Swizzy, Swizzy dollar. So, most of these currencies also have nicknames as well. Right. So whenever you see S30, Dow Jones, this is still refers to the same thing. Then we have Gen 30, which is a different one. I have also Gen 40, which is also a different one. We have SP 500, which is sometimes called US 500. So if you see this as well, you are still correct. US 500, SP 500, whatever it is, right? So these are all um, have HK 50, Hong Kong 50. Right, so these are all indices. But the ones I focus on, right, the three you should focus on are these three, right? SP 500. Those are the ones that are US based. Right, these three are based in the US. Right, the Nasdaq is based because it's in the US. The US 30 and SP 500 is also based in the US, which is also called US 500. Right, these are the three I should be looking at. Right, but SP 500 is usually very slow. Right, so I usually prefer US 30 and NAS 100 because of their quick movements. Right, so that's basically what to do. So now let us talk about the strategy to trade it. Right, how do you trade CFD indices? Right, it's just very similar to what we have been doing so far. Very similar. Right, so basically, you want to see the market create your Asian range. Right, then once the market creates your Asian range, and then you mark your midnight candle. You have to get about the power of three. Right, so typically, when we are in the New York session, if you're bullish, typically you want to see the markets then move around, play around, keep moving, keep doing this thing, then maybe drop below the open price, and then by 9:30, you want to see market give you what? That bullish trade. So from 9:30, you want to see market give you that bullish trade, right? Something like 9:30. And it's a plus if you see London liquidity taken. Maybe you see it price take a London liquidity, that is also a plus, right? The price take a London liquidity, and then most times you're looking for a fair value gap there. So most times we want to see a trade inside the fair value gap. But this is also basically how you trade. So we want to see market number one close the Asian range, drop below, and then give you a bullish confirmation inside what that's time window 9:30 to 11 a.m. So the trick here is that you don't want to enter a trade before the session opens, or even if you enter, right? You enter if the setup present before then you have to weather the volatility. So, but I like to wait for the market to open first before entering, so that the quick volatility does not take place. Sometimes market can be just volatile. Sometimes I've been in situations where the US 30 markets opened and then it took me out before reversal. So that's 9:30 volatility. Right? If price is very close to your entry, it's always best that you wait for it to open. But if price is not close to your entry, then you can just capture the whole move. But most times I like to see price, you know, I like to see price far from my entry before I allow a trade to hold. Right? But if it doesn't do that, then that's cool. Let's just look at this is what happened yesterday. So we had our Asian range here. We are bullish for some reason. We saw our other block that was tapping to right here. So can see high 930 candle opened. Right, this you can see this other block here. Right, so market went below the midnight candle open, and then that was a bullish confirmation here. So market pushed above and then came back, tapped into this point here, and then you can see how it was. It pushed towards this high. So it's a very nice trade. You can see this high here. It's equal high here, right? So bullish confirmation after that. And then if you look at the 5 minutes time frame, you can see that there was also an entry by 930. So let's look at the 5 minutes time frame. So you can see it here. Very, very clear. So when I can step into that other block there, you can see how price what gave what a bullish market structure shift here. So markets went above this swing high here. So you can see that was a very good one. That was a bullish market shift. And then you can see this imbalance here. So you can see that would have been your entry. This imbalance here would have been your entry. So most trades on this guy, he plays on imbalances. Remember the model I just showed you, right? So this is also what happened. We hit our other block. You can see they had the 930 candle, reacted. I can see how the market this kind of 930 candle, this big red candle here. So market just came to your PY activated and then what pushed to the upside, right? So this was been a very nice trade if you bought it. Right? Although I was not watching this, but this would have been a very nice one. So maybe if you bought here, stop loss just below the swing, this lows here, then maybe this would have been a fixed take profit. This one is to 2.2, then this overall high here would have been 1 is to 2 points. 1 is to 2 point, 1 is to 3.8. Right, so that is just it for CFD indices. So it just gives you a specific time to trade it, right? There's a specific time to trade indices, very specific time, right? Very specific time to trade, and it has a specific model, right? So that is it. That's a very, very, very nice one, very nice trading indeed, right? Look at another one here. Why is not that here? So something is wrong with my Asian indicator too. All right, so that is it. Let me for 930. Yes, 930. 930, 930. Okay, this one there was no clear move. Huh? I don't think my time is correct, but this is not Asian range. Asian range is yeah. Alright, so this is not Asian range. So I think I should take this off. Right. The Asian range is actually here. I'm looking at the time, I can see Asian range is actually around it. It's alright, so this is Asian range from here down to this point. So let us be very accurate with that. So this was the Asian range, right? So this was it. You can see a bracket ran below Asian range and then did that thing. So this is actually the Asian range, right? So that is need to confirm that I was correct. So that is basically how to trade this, right? Basically how to trade it. Now this is a best example. I have an Asian range here between 8 to 12, 8 to 12. So Asian range is here, somewhere around there, 8 to 12. All right. So this was a bearish example here. You can see how market gave a bearish break. Markets went below this low. So where's our 930 candle here? So 930 came around there. This 930 somewhere around the right. So this 930. This red candle, 930 candle. You can see how market that red candle do what? You can see the volatility. How it does what? Dropped, right? Well, that would have not been your trade. We're going to market to drop and then come back into a fair value gap. So your end would have been this fair value gap here. Maybe around the stop loss above the high. That would have been a very nice trade as well. Maybe 1 is to 1 or something. So if you sold there, you're targeting here. Maybe one is to 1 or thereabout before the market to the west. So that is just it. So in this case, market will just give you a short reversal and that's right. So that is it for US 30, right? So US 30 and US 100 is always best to trade this approach. All right. So one last thing I want to mention. Okay, we'll talk about it tomorrow, right? I don't want to make this call very long, right? We'll talk about it tomorrow. I wanted to teach you guys about the SMT divergence. Let me just give you guys a quick recap. Now, we know that Nasdaq and US 30 go in the same direction, right? So that means let's just do comparison. This is the setting definition for tomorrow's class. So let's just set the definition of tomorrow's class. Just set the little definition of tomorrow's class. So Nasdaq and US 30 are what we call positively correlated, right? So Nasdaq, right? Remember I gave you 7 names on Nasdaq and I also gave you 7 names on US 30. So US, these two pairs are different, right? So they are what positively correlated, right? Most of the time. This simply means that um this means that most times they move in the same direction, right? They are positively correlated. US 30 and the Nasdaq, right? They are positively correlated. Now, um, in their that means if US 30 makes a high, Nasdaq should similarly make a high, right? So that means if US 30 makes a high, Nasdaq should similarly what make a high, right? So if this happens on US 30, right? If this happens on US 30, so we should also see something similar on Nasdaq and below. All right, so this is Nasdaq, right? So market should also give what a corresponding high on the Nasdaq, right? So last 100, and this is what we typically see, right? A bullish high between the two. Well, this is what we call correlating, right? So now there are cases where US 30 might make a high and then Nasdaq will fail to make a high, and this is what we call a divergence, right? A divergence, meaning that there's a divergence from the norm. The norm is what positive correlation, just like we have Euro USD and GBP USD, which are what positively correlated, right? Yes, that's just like euro and the pound dollar are positively correlated. That is the same with US 30. And if you check gold and silver as well, gold and silver are also correlated, right? So tomorrow we'll talk more about correlation, right? That's what we really dive into tomorrow. Positive correlation, negative correlation, strong correlation, all those fun stuff, right? So these pairs are correlated. So that in cases where US 30 makes a high and Nasdaq can refuse to make a high, this might mean what? That the Nasdaq is bearish, right? So let us does I think we'll just continue this particular teaching tomorrow, right? This particular one should be tomorrow or maybe in the evening session, right? In the evening session, like depends on if I'm able to make it for the evening session, right? So let's just do it. So let us have so if you want to compare it now, you just click on compare to you click on US 30. You want to compare and see. I'm not show you something so you guys understand why it's positive correlated. Then tomorrow we'll talk about divergence. Right. So today we'll talk about the positive correlation aspect, and tomorrow we'll talk about what the divergence aspects. Right. So let us make it so you guys can appreciate what I just said, because there's no point saying something without showing you guys why you should appreciate it. Right. So I'll show you guys the positive aspects. Then tomorrow we'll talk about the negative aspects. So first, this was CFD indices. All right. So let's look at it. Now, if you look at this particular pairs from the let's zoom out. You can see that these two pairs relatively go in the same direction. Right? You will see it clearly now. You can see that they relatively go in the same direction. When the US 30 was bullish, you can see how the Nasdaq was bullish. When when Nasdaq started dropping, you can see this guy started dropping. When this guy resumed bullish, you can see this guy also resumed bullish. So this is why we will say that they're positively what correlated, right? So when this guy dropped from here, the other also dropped from there too, right? They are positive content. It doesn't mean they have exactly the same chart. At times in which they have what's a divergence, but you can see how they move already most times in the same direction, right? You can see it. You can see this drop here. You can see this also drop as well. You can see this guy start pushing slowly bullish. You can see this one start pushing slowly bullish, and all of that. You can see this massive drop from here. This drop here. You can see this drop also happen down there. So they usually move in the same direction. So there are cases where they diverge, and that is what we're talking about tomorrow or in the evening session, right? The divergence aspect of this, right? So you can see it. So you can also do the investigation yourself to confirm this, right? So let's just wrap it up for today. So if you have not subscribed to the channel, please do want to subscribe. Click the like, click the subscribe button. Share this video with your friends so you guys can learn one thing or two I have taught today, because we're going to talk about divergence in more details in the next session, right? So have a wonderful day. I'd love to see you guys in this. This is session 20 of 30. So I'd love to see you guys in session 21, right? So have a wonderful day. Cheers and God bless.